Welcome back. You're watching NDTV Profit. Now the Financial Leadership Conclave 2012 is on in Mumbai, where India's top CFOs are speaking. Let's cut across to that.
I think never have I felt so intensely pressurized to discover new levers of competitiveness. It's not going to be just the client's benevolence to give a price favoring the track record of the company or the execution skills of the company. There are far too many people competing for the same opportunity, and maybe many of them with similar or better credentials. So I think the discovery of cost competitiveness has acquired a completely new meaning. Second, all of us have learned to deal with this environment in a manner of speaking, to do more with less. Productivity, whether it's men, machine, capital, or in any other form of processes that we engage, productivity has become a key differentiator. How much more can I deliver with lesser consumption of whatever inputs that I need to has become very, very relevant and a critical differentiator. It's part of a winning strategy. And the third bit is the whole issue of where to deploy the valuable resource that each company commands. I think there were times, I remember even within L&T, where just the fact that we are able to raise resources was an advantage. Today that advantage isn't as significant as it used to be. Today resources do chase good cause even in these times. So considering that, I think it's very important the maturity of capital allocation decisions, the alteration of the thresholds, because what was a good measure 3 years ago is no more a good measure. It's not good enough to deliver value. So the entire benchmarking of what is the yield that would deserve the risk that capital chases becomes a very material fact. So some of these have fundamentally changed, and we're trying to learn and cope with this situation. The only comfort is none of us have been in similar situation before. So there is no disadvantage that one suffers from the other. Everybody is trying to learn and cope up with this. So I think it is testing the temperament of the management, temperament of the organization, and perfect time for the wheat to be separated from the chaff.
It's only tested the IT sector the last 4 years, right, in various ways, Mr. Malin. Let me come to you on that. I mean, some of the points that were raised by Mr. Raman, cost competitiveness, productivity, how you deploy your resources, all of those and even beyond those, how have you sort of tackled the last few years, and how do you continue to evolve?
Just want to make one comment on what Shankar Raman said. It seems to be a very stressful time for CFOs. So,
maybe that reflects that the pressure is shifting to the domestic end.
I'll give the overall view of the industry and then come to the point that you have raised. See, I'm in an industry where if we are looked upon as people who can give additional value, and therefore whether the company is doing badly or whether the company is doing well, they look upon IT as something that would enable them to progress, and therefore it's a good place to be in, because especially companies overseas which are in some amount of difficulty, they need to take the cost out, and therefore this becomes an arbitrage game, cost arbitrage game. And of course, if companies are doing well, then they look at it as infusion of technology, and therefore there is an advantage and so on. But now if you go to any part of the world, whether it is United States, of course there is an election, so you've got different viewpoints, there's a lot of noise that is there. You go to Europe, especially if you go to Southern Europe, you can be very badly depressed. I was in China last week, and China itself is going through its own issues. The growth coming down to 7.5% and so on. So that is going to be a very major one, which is essentially pulling down many of the new trading bloc, including some things in South America, Australia, and many of those countries are getting affected and so on. So you've got an external situation which is not an extremely good one, and of course that makes you feel that the domestic situation is somewhat better than what you see externally.
Good to hear you say that. I must quickly jump in. I'm sure Dr. Gokul is happy to hear that.
So in that context, while I've said that, the market is there. in the sense that if we are able to provide the right kind of value to the customers and make sure that they are able to operate in this environment more effectively through outsourcing, that's an important one. But at the same time, there are pressures that are developing. One, of course, as far as productivity is concerned, the costs are rising here, and therefore, obviously, you have to essentially work on different, the productivity of all the resources that we have. This is a field which is a new field, and you're working in large teams and so on. There are quite a few techniques that we employ in terms of ensuring that we are able to measure the productivity and hopefully create new benchmarks and set things this one. But at the same time, the critical issue for people in this industry, especially those who are dealing with exports. I've got another colleague who is going to come in a little later from the Indus, is really the exchange. I think Dr. Gokan talked about it. The main thing is that the volatility is really creating a huge problem because July of last year we were at 43.85. And what we were, and on a daily basis it is something different. Yesterday morning we opened in a different way, and then today, of course, we have opened slightly more depreciated manner and so on. And so the point is really the volatility. It's not that if it was a one-day movement, then it is a different matter. There is this, and that is an extremely big risk. Of course, hedging is an important one. We do quite a lot, but there is one thing that I want to introduce there, that the amount of education that you need to give to a lot of people on hedging, that is especially the investors who are essentially looking at us, is phenomenal, because they look at it as a loss when they report it in the accounting. The accounting portion is a very critical one that most of us don't look at. Like for instance, I begin the year saying that I've got a budgeted rate, whatever it is. This year we started with a budgeted rate of 49 because it depends on the date when we do the plan, and then we take that and then arrive at some sort of an EPS that I need to deliver to the investors, and that's how we do that. And so long as I'm able to do that, as far as I'm concerned, I've done my job. But when it is at 54 and when I've taken some forward covers and I've foregone that, as far as the investor is concerned, I've done a terrible job. And when I say investor, I'm not talking about these retail investors, I'm also talking about the owners. And therefore there is this whole issue of management. The critical thing in terms of defining what is an appropriate management issue is something that's also very critical.
Well, since you brought up that specific issue, and Dr. Gokan brought it up as well, let me get to Mr. Sen on this. So banks have faced the brunt of volatility. They advise clients, etc., as well in terms of tackling volatility. So let me first ask you a current question. Do you see the current environment being relatively stable? Do you see the potential for volatility to come back any time due to any reason? And hence, once again, if you take it to the corporate sector, would your advice be to be prepared for any all eventualities?
I'll just step back a little, just to provide the perspective of the industry that I represent, banking. I've been talking about banking in the presence of Dr. Gokan. But as a bank, we have to manage our own balance sheet and risk profile, and we have to manage that of our clients.
Yes.
So I think we have to manage the optimal balance of the two. So if you look at our own internal imperatives, what are our imperatives? Our imperatives are to provide adequate service to our clients, which is the heart of your question. Second is to ensure appropriate governance and compliance with rules and regulations. And third is to optimize and manage our risks. I think these are the three. And if we do these three things well, we as a bank, manage our franchise appropriately. So as a result of the trends that my colleagues, co-panelists have talked about, as a result of globalization, and you mentioned about increasing volatility, because the world has shrunk, because the risks in the environment have increased, because tariff barriers have broken down. So obviously the risk in the financial system has increased, and we've seen that in the last 3 or 4 years. And in addition to what
Sorry to interrupt, Samir. I request you to hold the mic a bit closer. I think people in the back are having trouble hearing you.
Sorry. So as a result of all of the whatever happened in the financial world, I think, there are two things. One is that there has been an intense kind of, and very appropriate reaction from regulators the world over in terms of what is the reaction, what is the different kind of governance framework or regulatory framework that we need for the banking system to cope with these risks, and in order to manage the internal robustness of the bank with the sophistication that is required of this new world. That's one. Secondly is that how do we improve the overall governance and including the immunity to different types of risks. So in that context today, banks face regulatory standards which are much more deeper than that used to prevail earlier, be it the standards in terms of liquidity, be it the standards in terms of credit judgment. All of us are familiar with the Basel framework, which has added a new dimension. There are different other pillars of regulatory development that are taking place in the US, in Europe, in India. So all of these are kind of impacting that. So in relation to that, as banks manage their own risk framework and the balance sheet, we also obviously have to dimension our risk exposure, and that goes at the heart of what we can do for our clients. So therefore, the way we manage a credit exposure for a client, the way we managed it 10 years ago versus how we manage it, the quality of that risk exposure, the consumption of capital as a result of that risk exposure is very different, and measures have become much more sophisticated. Similarly, in terms of the volatility in the client's exposures that causes price and liquidity risk for the bank, as well as, for example, dealing with clients across a variety of jurisdictions in terms of the operations risk that it poses. All of these are hugely demanding on capital, and Basel demands that we demarcate capital for each one of these parameters. So therefore, coming back to your question, which is how do we advise clients? So we place a tremendous premium on suitability and appropriateness. The products that we offer to our customers, the kind of an exposure that we ask the customer to make depends significantly on the extent of their management capabilities, on the industry that they operate in. So somebody who's operating in an industry that is prone less to cyclical behavior versus a customer that is operating in an industry that is much more cyclical will obviously be very different, and these measures are taken into account in the way we manage our exposures, the way we price our exposures, and the way we offer products to customers. Quite a different dimension of obviously is the geographical diversification of the client. Obviously, to the extent that a client has cross-border exposure, you can manage your risks that much better because you can balance downsides in a particular environment with upsides of that. So I think these are all the dimensions that we take into account in our decision making. Obviously, this becomes very critical, in the case of a global bank, where the risks that we face on our customers in India get exacerbated and multiplied many times over as they are integrated in our head office. So I think it's very difficult to give a very short answer to your question, but to sum it, what I would say is that we are extremely judicious of the risk profile of the client, not only the client's internal risk profile, the industry profile, and we manage all of that in our decision making in terms of exposures that we take, not only on our balance sheet but also off our balance sheet.
Absolutely, sort of two ways to look at it from the banking perspective. But I guess the question to ask Mr. Anand, you can help us with this, is our clients equally sort of aware of the kind of risks that could come through now? Are they far more judicious in terms of taking risks? Because as recently as a few months back, we've heard of instances where people just want to make money on the currency move, for instance. I'm obviously not talking about large corporations, sophisticated corporations, but I'm just wondering if the awareness of these risks has now sort of widened. Are people more aware and hence more sort of comfortable with taking them, or more judicious about taking them?
So I think the extent to which people are aware of this organization and within that individual. But responding on this point a little bit more broadly, I think one of the things that we have learned is that the last 4 years have dramatically changed the needs of our customers and their...
Sorry, may I request you to take the mic from
the needs of our customers as well as their behavior. So it is very important for us and any organization to question whether the offerings and the strategy of the past is appropriate to the situation that we now find ourselves in. And we have found that a number of the things that we used to do in the past are not appropriate anymore. And for example, it is no longer correct to say that there is a behavior within a particular industry or there is a behavior within a particular geography. What we find is, for our clients, in the same geography, there is somebody who's growing, who wants to invest in his business. There is somebody else whose business is under pressure, and therefore their needs and their behavior is completely different. Additionally, what we find is that in this changed environment, most of our customers do not have the kind of profitabilities that in our industry we have in India, and they believe quite rightly that we do not have a God-given right to that kind of profitability. So going back to the point that Mr. Mahalingam made, we have to demonstrate that that is the value that we are adding. Otherwise, the business opportunity will no longer be there. Going on to the second point that you wanted me to talk about, which is on understanding risk and what you can do to mitigate it, I think we always have to remember that the flip side of risk is opportunity. Okay, if we do away with all risk, then we will not make profits. We will not have that opportunity. So whether it is hedging or something else, I think we need to understand that the objective of hedging is to mitigate volatility. You can never completely eliminate it, because as Mr. Mahalingam was saying, if we had 2 years back hedged ourselves 100%, the tailwind that there is in our industry today from the currency depreciating, we would not have that benefit, and compared to competition, our performance would look disastrous, as well as we would not have the financial headroom to do some of the things that we need to do today. So hedging is all about mitigating volatility, and I think the big thing for people in business is to be clear that is what it is. It is not something which should be leveraged to look for trading profit, because I think there are specialists who try and do that. Most of them don't make profit at it consistently. For us to try and do it, I think is asking for trouble. So we need to just kind of mitigate volatility, and we need to look at what are the risks that we want to outsource the management of, and which are the risks which are core to our own business, and therefore we are comfortable managing it internally.
Excellent.